Hello, I'm Greg Bennell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights to help boost your trading potential. Coming up, market volatility taking center stage as the second quarter kicks off. Cautious vibe out there, investors bracing for President Trump's anticipated tariff announcement on Wednesday. Plus, gold shattering records, soaring past $3,100 per ounce. Could this be the start of an even bigger rally? And our trader debaters are standing by. They're talking the rails today, Canadian Pacific, Kansas City Railway. Is it a coast-to-coast rail titan or an overambitious risk? That's all ahead. You're watching TD Active Trader Live. Let's check in on the market action. First trading day of the second quarter. If you're long the markets, you're probably happy to have the first quarter behind you. As we said, a bit of a cautious tone out there. We started yesterday the same way, didn't we, though? All the concerns about the tariff announcement that is coming tomorrow, Wednesday, had the markets under pressure at the open. And by the end of the day, the S&P 500 managed to push itself into positive territory. Right now, we are modestly lower again as we get closer to that big announcement. Tech sold off yesterday, but the broader market did manage to flip things into the green. I want to check in on the heat map. I want to see what's happening beneath the surface, where this push and pull is coming from. Bit of green on the screen for some of these big tech names, but it's not really anything outsized whatsoever. And we got a few other names taking points off the table, so there's that sort of fight we're having in the markets right now. I want to show you a few individual names. PVH Corp. We hear so much about the cash-strapped consumer, and we know that they're feeling the pinch of the cost of living, but there are some items apparently people just don't want to give up. This PVH is the parent company of Calvin Klein and Tommy Hilfiger. It appears if you have a brand that people want, you're managing to hand in a beat on the earnings and revenue lines, which they did. Now, they are warning of a challenging economic environment like other retailers, but investors seem to like not only what they're getting from the name today, but the forecast as well. And we got a double-digit pop in the stock right now, half an hour into the open. Johnson & Johnson, I want to check out this one as well. It's down to the tune of about 5%. A U.S. bankruptcy judge has denied the $10 billion baby powder settlement. The proposal would have put an end to thousands of lawsuits alleging baby powder and the other talc products caused ovarian cancer. Now, J&J has been trying to resolve the suits through a subsidiary company's bankruptcy. That's why I said a bankruptcy judge. Didn't make sense to me at first until I got into the details, the one denying this. J&J calls the claims about its talc products meritless, and they say they're going to continue the legal battle. And that's your market update. All right, joining us now for a more technical take on the markets is Hiran Amin and Jason Natick from our direct investing team. Here we go. Got another show ahead of us. And Hiran, you're going to take it away with that technical take?
Yeah, let's start with the Dow Jones, the big industrials, of course, Greg. I've got the chart pulled up here. I wanted to look back and see how the industrials are shaking up on the heels of, well, tomorrow, Wednesday, to see what comes out of it. One thing just wanted to point out, big headline that came out yesterday was Goldman Sachs. You know, we were talking about the big R word, which is a recession. They had actually upped their probability of recession from 20 to 35% now. This is, again, as sentiment deteriorates. We saw that on the Michigan consumer confidence surveys that have been coming, it's been lower and lower consecutively for a few months. And obviously, Washington's big rhetoric coming out of the weekend was they're more signaling more tolerance for deeper economic slowdowns. So the Dow Jones is one I wanted to take a look at versus the others, because the idea with the Dow is basically these are the big manufacturing industrials that make a lot of the goods and products that American consumers actually consume. So looking at the charts right now, we're still maintaining a very strong trajectory in terms of its overall long-term uptrend. You can see I have these two lines. The upper bound over here just kind of breached that, but the lower bound is way below at the 35,000 level. That's like a doomsday scenario. We hope we'll never touch that lower bound. But what we're keen on looking at right now is we've seen the Dow break below its few moving averages. Now, by the way, I am looking at a weekly chart because I want to look at the weekly closes over here. So this is what it's weekly candles that we're looking at. It is firmly sitting on this support right now. And that's that 41,000 level right now. We saw the Dow's a little bit weaker today, but this is where we're going to keep a very strong eye on. If it does break through this 41,000 level, we could see some more downward pressure heading towards the 39,000 potentially there. Now, the other thing that I wanted to also analyze in the technical world, the Dow theory, which really forms the bedrock of technical analysis, it postulates that anytime you see an index or a broad index moving in one direction, it has to be confirmed with the other one. And in this case, the Dow, we're going to look at the Dow Transportations Average. So that's just ticker symbol DJT. And essentially what this is, and I'm just going to hide out my drawing sets for a moment, is the Dow the theory behind why we look at the transportations with the industrials is whatever the industrials make, the transportations take, essentially. Move those goods around, the logistic companies around there. And anytime you see one sort of weakness faltering, and in this case the transportations, they always kind of lead the move down, and you can see it's a bit weaker on the year so far with the channel that we have. So this is just to confirm that we're seeing overall weakness also being confirmed by the Dow Transportation Average as well, and the logistic move is there. So that's one I'm going to be keeping a close look on as well. All right. The gold bug.
Gold, the precious metal.
Yes.
Yep.
Let's look at that.
Hitting new highs.
It is hitting new highs. So again, I've got the daily chart pulled up on the gold futures contracts over here. So news coming out is, I think the big thing is the gold bug's obviously caught on. It's hard to shake off at the moment. Just look at the stats right now. Gold ETF saw the largest inflows over 2 months record. That's $12 billion of inflows. It's the largest since 2020, in fact. We've seen a real pile-on in this. A lot of it's being driven by central banks, of course, really shoring up the gold and pushing the prices up. It has hit new highs, sitting at the 3,162 level. Right now is where it came off of that. It's also the biggest quarterly rise since September of 1986. Oof. So it is on a bit of a run over here. It's also formed new all-time highs. In fact, this year it's formed 19 times. It's made new all-time highs, 7 of which have been over the 3,000 mark, which is just hit over here. So what we're seeing over here is obviously this postulation towards more risk-off environment, and that's when we see gold really being bid up over here. Looking at the charts right now, we still see I've got a regression channel drawn up here, and I'm just going to take this off for a second, but we're still way away from the upper bound range over here of the regression channel. And what we could even see just on analyst forecasts and target numbers thrown around, 3,300 is the next sort of target level where it could go to 3,500. But what we're looking up firmly is it's well above the moving averages. We've got it above the 21, the 50, and the 200-day, quite well clear of those levels. And even on the relative strength on this, if you look at them, they're just screaming kind of in that overbought region right now. But when you have a strong trending as gold is right now, this is not one where it's a signal for a reversal just yet. We're probably going to see natural sort of pullbacks coming in, but it's still headed very much in the upward trajectory, probably pushing that $3,200, $3,300 range there. And then finally,
there's been a lot of talk of the last week. You're going to use sector rotation, right?
Yeah.
Like people have been starting to wonder with the tech stocks that got such a big push out of AI, not doing so great this year. Where is the money going?
Exactly. So let's look at the sectors. I pulled up some of the sort of the broadest sectors in the S&P that have been seeing a bid, and some of the laggards over here. So we've got 5 queued up here. You can see right now the clear winner kind of at the start of this year so far. You can see the energy in purple over here is the winner right now. It's sitting about 9.9% year to date, healthcare and consumer staples. So this is really defensive posturing. What we want investors to take out of heart from this is to understand that, it's not a complete risk-off environment where you kind of see everything just fleeing away from the equity space, but it is still just moving to more, defensive sectors where investors still want exposure there. Obviously, the ones that are the biggest laggards out of the sector space is consumer discretionary and the tech, seeing a rotation coming out of there. So again, if a consumer is a bit more cost conscious or they want to have some asset allocation, these are potential sectors they could also, look at to see if they want to rebalance or shake out some of that volatility out of their portfolios.
Interesting moves in the market. You're looking at a stock that had a very interesting move yesterday off of news, Moderna.
Yeah, we're looking at Moderna. So obviously a big, drug and vaccine manufacturer, played a big part during the COVID crisis and coming up with vaccines to kind of support society here. But this is a company that their share price price. Not a lot's gone right for them. The move that's gone on over the last kind of 4 years would have been inconceivable like 2 years ago, let alone over a 4-year time period where the stock was, reaching almost $500, right? Early yesterday morning, there was big news from the FDA. A gentleman by the name of Dr. Peter Marks, he's the Center for Biologics Evaluation, has resigned, and it feels there's some concerns out there in the medical community that this might be signs of vaccine skepticism creeping into from a policy perspective, and many drug makers have been feeling the pinch. So I've got up on the chart here for mRNA for Moderna. You can see there over the last 4 years, there's been some precipitous drops in the stock price, and as we zoom into kind of more recent price movements, it's been the bearish signal has been really piling on. Kind of mid last year, we noticed there was that infamous death cross. We got our price and double moving average crosses towards the downside, and then as we even move closer into kind of near term, the company has pulled back to kind of almost near lows where they've never seen in the last half decade. We've reached what could be a psychological point around a $30 price point. So we'll see if that's able to hold with the downward pressure the company is facing. But ultimately as well, we're noticing even just I've got the RSI up on the screen. We've not even broached oversold yet, so there still could be some room for the stock to continue that downward move.
All right, interesting technical takes there. Thanks for that, guys. If you at home have a question for our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. You can find more information about all of our trading platforms under the Get Started tab, so you can find the one that is best suited for you. Whether you're a new or seasoned investor, TD Direct Investing has you covered and has, once again, for the 3rd year in a row, been ranked as the #1 online brokerage in Canada by the Globe and Mail. It is time now for Trading Debating. It's all about the rails today. This week, the stock in the spotlight, Canadian Pacific, Kansas City. Before we get started, just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Options trading carries high risk, may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. All right, back to the stock of the hour. Canadian Pacific, Kansas City, or CPKC.
Bit of a mouthful.
It's a mouthful, so I make sure to roll with the rhythm and enunciate this. What made you guys pick the stock debate other than making me say Kansas City?
Put you on the hot seat.
I got the order reversed too. Just to make me say that over and over again.
Yeah. No, just, railroads, obviously, they're integral part of, kind of what I alluded to, transportation averages, moving goods from one coast to the other across land masses. So this one was worth to look at. I'm also a personal big fan of Ticket to Ride, if you ever played that game, about building a rail network.
Classic, yeah.
Nothing to do with this, but I thought, hey, let's get into the nitty-gritty of exactly what it costs to run a rail business.
And I understand in a former life, Jason was traveling with his acoustic guitar,
the
1930s kind of hobo riding the rails, little campfires. That's who you used to be, right?
Yeah, right. I'm old school vagabond there for sure.
You'll find a YouTube video of him out there somewhere.
Don't
look it up.
Yeah. No, but with tariffs on the tip of everybody's tongue, this is a company that really helps connect the economies of three countries here in North America: Canada, the U.S., and Mexico. So it'll be interesting to see how it plays out for the stock.
Okay, let's get some time on the clock now. As always, each 2.5 minutes to make the bull and bear cases. Draw from the hat. And we found out who the bear is going to be. So I think, Hiran, you got the bear case. Why don't you kick things off?
I have the bear case. Yeah, exactly. So as Jay teed me up a little bit. It is so just analyzing the railroad industry as a whole, and CP in particular, very highly sensitive to economic sort of conditions, and it's facing several headwinds that could pose challenges for its sort of intermediate to long-term growth here. So let me lay them out for you. First thing I want to talk about is this is a freight carrier, of course, Canadian Pacific, Kansas City. That's the one time I'm going to say it, and that's it. I'll refer to it CP from here on. But when you look at the revenue streams and the goods or products it really just transport, coal makes a significant part of that revenue as part of its portfolio. Now, what's happened in recent earnings report is they've seen declining across all the big freight products that they carry. So revenues have declined for 6% for coal. We've had potash decline approximately 4%. Metals and minerals have also also declined there. And consumer products are down about like 21% there. And intermodal. So intermodal was one I had to scratch my head and think, what is intermodal? So it's basically taking those big shipping containers you have and they just really put them on the train, get them to where they need to go. And so that's even slightly coming down as well. So that's a big thing that's going to hamper growth across the board there. The other thing is tariffs. Again, I said it's economic sensitivities. It runs with the business cycle, and with tariffs coming in, inflationary pressures and stagnant growth, that's going to all trickle down. If manufacturers are not producing those goods, trains are not going to be moving them. So, and CP is going to be one of the unlucky beneficiaries in this case. The second thing I'll mention before I jump into the charts over here is rising CapEx spend. They just guided almost 5.5% increase for this year in CapEx spend. But you know what? The volume of freight increase, what they guided was mid 5% as well. So they were saying we're going to increase our volume by 5%, but our capex is also going by that much. So net even, it's 0-0. Let's look at the charts here. I've got the weekly charts pulled up. What's the price action showing? Well, it's just really gone nowhere for the longest time. I've got the weekly chart that I'm looking at. It's kind of been rejected off of these levels at 82. We're nowhere near that at that point. We've kind of resumed a downward trend over here now. We're making lower highs and lower lows definitively here. What you'll also notice is very big bearish candles that are coming up on the weekly charts over here. It's also broken through this level, which has kind of been bouncing off of for the last few times. So it's making me think if it continues holding this, we could get into that demand zone where it could get into that 62 to 64 region here. So that's kind of where I'm seeing there's a base case scenario where there's some pressure that they're going to head with the economic sensitivities.
Look at that, right to time.
Well timed there.
Yeah. Old school music DJ. They would talk right up to the singing began.
Right there you go.
Taking it to the post, they called it. All right, Jason.
All right, let's
You're
take
the bear. What's the bull?
I'm the bear. So I'm the bull. Yeah, no, I'm not the bear. Let's not go all April Fools on you here. But no, I'm going to take the bull side of things here. So they're one of 6 tier 1 carriers in North America. They took 2 middling companies and combined them into kind of one large behemoth, and that's going to allow them to really benefit from economies of scale. This is a company that has over $32,000 kilometers of track, and really get this. Yes, I know tariffs are going to restrict flow between countries, but this is one the only railroad that has transnational North American network that'll connect Canada, U.S., and Mexico. They've got access to ports on both oceans, Pacific, as well as the Atlantic and the Gulf Coast as well. So whether or not they're moving goods internationally or within the countries, they're well set up to play tariffs or not. They're well positioned. Let's take a look here. The merger has also created an economy of scale that's allowed for more efficient travel. They've been able to create longer trains, faster network speeds, and they're actually requiring less crews, so there's savings all across the board. All right, and that's maybe part of the reason why analysts are seeing almost a 30% upside in the stock when we look at their ranges on the stock price projections. All right, a couple quick things to point out before we jump into the charts. One being a key metric for railroads is called operating ratio. It's where they're taking, they're looking to, let me make sure I get this right. They're a measure of calculating their operating expenses as a percentage of the revenue. Anything near 60 is good. CP in Q4 of 2024 came in under 60 at 59.7, being one of the leaders in the industry, so that's really nice. And next is taking a look at labor. I know you're going to probably bring up labor a little bit, but this is hopefully a sign of things to come. They had a nice agreement coming in later in February with some of their mechanical employees from Uniforce. That was really nice to see, and hopefully, like I said, a sign of things to come. But let's take a look at the chart and jumping in here to take a look. First and foremost is I want to look to see where the stocks are going over a longer period of time. We do see we're not looking at home runs here, but we are seeing steady gains over a 3-year period. So the stock is up over 16%. So that's really nice to see. But then zoning in on kind of the trend that we can see here, we've got the stock is kind of bouncing between that 84, 68, kind of that zone around there. But right now the stock has retreated down towards the 68 level. But what's nice to see here, the stock is not broached below that. But there's also other key signs that I'm seeing here as well. We had a nice green candle with a relatively short bottom wick that's showing that their strength towards the values dollar signs that people have seen. But then looking to find reversals in time, looking at kind of more shorter term, trying to find around the 180-day, looking at 90-day, as well as looking at 30 days. We're seeing crossing in from oversold into the normal area of RSI, so chances to make that 68 stick.
A little too aggressive on that one. Still going on my ears.
Got a bit of a ring going on.
That operating ratio, the way it was explained to me years ago, was it's like golf, right? The lower the better. Because sometimes a young reporter would get their head turned around in earnings. He's like, oh my God, their operating ratio dropped 3%. He's like, that's good. That's good for a railway. That's what they're looking for. All right. The bear or the bull, they've laid it out. Time to mix it up. We call this the counter.
The counter.
The counter.
It's dramatic right there.
You got 3 minutes for the counter, gentlemen.
All right, I'm going to lay into the fundamentals first with you, Jay.
Okay.
Let's start with the top line. Enterprise value to EBITDA is a big ratio that's looked at across the board with railways, mainly because it's a very capital-intensive industry and depreciation and amortization are a big thing. When you look at the enterprise value, they're at a premium compared to any of the closest competitors, and they are not even the biggest in terms of revenue or even freight volume. It stands at 15.4. When you look at UNP, it's 14.3. CN's at about 12.5 there. So that's one thing I'm going to talk about. Also, on the PE side of it, they're also high, a 25x multiple when the industry average is sitting at 18.2. So again, it gets me questioning where is the real growth? And you might argue and say, well, it's being priced in for a premium because there's growth there.
Right.
I'm just not seeing that follow in freight volume or anything else coming through on that.
From a PE perspective, sure, it could be higher than the industry average, but it is actually coming down over. They're actually below their 3-year average, so there is signs that it's kind of correcting in terms of their valuation. Looking at their corporate structure as well, it's run by a gentleman. Their CEO is Keith Creel. He's actually a protege of industry legend Hunter Harrison. So he's implementing a lot of those well-recognized precision railroading principles into the company. So we're really looking to see where that's going to go. We talked about kind of what some of their main cargoes are on their freight trains, and coal being a gigantic portion of that. Well, they've very recently signed and extended an agreement with Teck Resources, obviously a gigantic coal mining conglomerate out of southeastern. They've got 4 mines in southeastern British Columbia.
On that point, do you know that U.S. rail call volumes have significantly decreased? In favor for electric generation. In fact, 8% is the decline that they had for shipments in 2023, and I'm imagining that's going to be about 10% when 2024 numbers come down.
But what are the priorities that the U.S. administration has talked about? Adding hundreds of coal-fired electric plants that are there for clean coal. That's something that's a priority that this company is well positioned to benefit from that. And second of all, who's the next biggest consumer of? And this is coal. That's a lot of it's designed in the steelmaking industry. This is China, and CP has direct access to the Port of Vancouver, allowing easy access to get that coal out of the country and into consumers outside of North America. So it's a big benefit there.
All right, well, we'll see what shakes out. The other thing that I think there's vulnerability is going to be there is the auto sector, because that's a big part of their manufacturing, sort of their freight carrying that they do on the bulk side of things. The auto sector is vulnerable just because of the tariffs and, with obviously saying that if they're not going to be producing as much cars, they're not going to be selling, they're not going to require as much steel or raw materials to really transport that. So that's also going to be a further dent that's going to come in. You talked about operating ratio, which I want to go back to because I have a slightly different number. They did come down meaningfully, but they haven't. My operating against the competitors, they're still the highest amongst them. 64.4, CSX is at 63, Norfolk Southern 63.5, 62 on CN. So there's operational efficiencies that these competitors are doing that CP has to still catch up on that point there. Well, I think they got to make up there.
Let's see everybody feeling good on a nice positive story that combines efficiency and the environment. They've actually rolled out and are operating 3 hydrogen-powered trains with production plans to bring in more that are actually going to be more efficient than electrical trains.
I gave you one little thought there over time. How you held that operating ratio.
You got to bring that one back.
Right till the end. That was in your back pocket. All right, so we've heard the bear, we've hold the bull. We got, of course, now a little time to talk about possible options plays around it. Since you kicked things off for us today, why don't you start with the bear case?
Yeah, let's look at it. So just going back to the charts here, Greg, I just wanted to look at kind of where the next sort of levels were that I think it could move to. So based on this downtrend that it's already in, one of the big things is it has broken off of this long-term uptrend that it was holding in place. And I can even zoom out a little bit for just our viewers, but you can see this dates back to 2020, where it kind of maintained it. It kind of broke off the line over there for a little bit during COVID, but ever since then it's kind of respected that trend until now. It's definitively broken down. We're in a downward channel. And the next level is really coming to that 62 to 64 demand zone that we're seeing, where we might see a bit of a bounce. So that's how I'm targeting and posturing that my trade is going to be a debit put spread trade, essentially. So I want to play that move down here. So here's how the trade's going to look. I'm going to pull up the option chain. There's a couple of things that are also going on the pricing. One of the things with CP, of course, it's only trades monthly options on this one. And I do want to give myself a little bit of time. So I'm going about 2 months out to the June cycle about there. 80 days out. Looking at the volatility profile right now, it's in the 88% volatility range, but it's not volatile comparatively to, like, tech stocks and other names that we're used to there. So it makes it a good value for a premium in terms of going long on the strategy. So what I've eyed here, and I've got the trade already set up, is looking to buy the 72.5 put for June and sell the 62.5, which will put me right at that demand zone if we do see a bit of a bounce up. Right now it's trading about $350 on the premium side, so that's what the cost would be on this trade. $350 on a single contract to get in that put spread there.
And the $350 is what it's risk.
That's what's at risk, yes. Yeah. So what you're going to risk is if the stock does in fact go the other direction, bounces up and crosses above 72.5 and remains there. If I hold it all the way till expiry, that's what I stand to lose. The max gain scenario is, of course, it comes down to my price, the lower strike at 62.5, and that's when I'll gain $6.50 in profit there, which will realize the full spread value of like $10 on that trade.
That's a possible way to play it as a bear, possible way to play it as a bull.
All right, so one of the key considerations for me, much like what Hiran mentioned, was around this only has monthly options, so you have kind of limited kind of choices when we're thinking about strike price. But the strategy I kind of landed on to kind of demonstrate a bull play here would be thinking about a long diagonal. Where that is, we're going to be buying something that's long term. In this case, I've decided to take the furthest expiration out, so we're almost 2 years out, so out into Jan 2027, and then thinking about selling shorter term calls against the long call that I've bought to offset that premium to make it a much more affordable trade over the long term, with the goal of getting as many sales of short term calls to get as much of that premium back off the case. So looking at the chain, kind of what the strike price that I settled on. As I said, we were thinking about going as far out as I can. I settled on $60, and the reason I did that was it's a nice round number, so it's I can get my head around it. But second of all, it's about $10 in the money, so because it's so deep in the money, it's holding. It's going to be holding its time value and the volatility because of the long term expiration. So I've got some pricing stability that's going to be baked into that, but also the extrinsic value that's there is actually going to be a little bit minimized. So I'm going to be able to hopefully make that up with as many rolls as possible. Since I've taken such a long time frame, I can now look to see that right now, ideally, if I can choose the right strike with a lower probability of assignment, I'll be able to get as many rolls in as possible. So thinking about a short-term strike, we could go as close as $70 and take in more premium, but that might be bring me the right risk profile, because my goal here for my calls that I'm selling is I do not want to be assigned. So if I look at my probability of the money, maybe I would normally be comfortable somewhere around the 30% level. I can maybe take that out even a little bit further, so I can really make sure, yes, I'm taking back in less premium to offset the cost of my longer term call, but I'm giving myself more chances to sell more and be then selective about strike prices as time kind of goes on. So if I go ahead and sell these 14% probability out of the money, I can go ahead and just bring in hopefully maybe 40 cents to offset the more expensive around $15 calls. So it's going to cost me about $1,700 probably to do this trade, which ultimately is going to be part of the risk that I need to factor in. But I'm hoping to sell lots of calls over the course of the life of that long-term call that I'm buying to offset the premium.
It's a long-term strategy, so when you're thinking about the risk going out for that long, like what's top of mind for you?
Yeah, there's a couple of things I need to keep in mind. I want to be making sure that I'm predicting the stock is going to stay above the strike price that I bought, so that's $60, because I am risking my whole premium up front. And there's no downside protection with this trade, so I want to make sure it stays over 60. And I also want to be kind of like I mentioned around the probability of in the money for my short-term calls that I'm selling. I don't want to get assigned too early in that, because if I do get assigned, I'll be forced to exercise my longer-term call, which is going to require either me willing to absorb a loss up front or lay out capital up front that I might not be in a position to do so if that's not part of my planning.
All right. Interesting stuff, gentlemen. Thanks for laying out the bull and bear cases for Canadian Pacific, Kansas City. And just a reminder to our viewers that this debate was for educational purposes, does not reflect our personal opinions about the stock. Now, before you move on, Jason, you're going to elaborate on tools for calculating implied volatility.
Yeah, so we've talked, many times here on the program about volatility. We want to not only be understanding kind of how volatile is the stock now, and we want to be able to compare kind of how volatile the stock's been in the past through the kind of the relationship between implied and historical volatility. So let's pop into the platform. I'll show you just kind of where here and I can grab that information. It's nice and convenient for everybody. I'm on the trading tab. We can see we've got our option chain up for CP. I was going to call it the full name, but I didn't want to give myself the chance to.
Jay, come on. You're the only one left.
Yeah. All right. So under today's option statistics is where we want to be focusing in on. All on the left-hand side is really where kind of the magic's happening on this particular. We're getting our current. We get our implied volatility, which is showing us at 33%. The first thing I want to look at is how does that relate to the historical volatility? That is telling you how volatile stock been in the past versus how volatile it is now. If the implied volatility is higher than historical, we're in a more volatile environment, meaning that we can expect to have premiums be a little bit juicier. But for that extra premium that you're taking in, you are taking on more risk. But what else is really neat that you're going to get out of this particular tab is you're getting, much like you would get a range of the stock price, you're actually getting a range of the IV range for the year. So we're getting you track to see where that is coming in. Oftentimes you'll see it spike around big events. You'll see it spike around earnings announcements. So you're getting to track how that's going. But there's two other key pieces of information that we can see that's coming up here. One is going to be your volume weighted average price. You can see for CP that's coming in just a shade under 70. So very, very similar to the actual price. But we're getting a track to see where the stock and the volume is kind of meeting in terms of where those are kind of aligning. And then lastly here, we have something called a put-call ratio. We brought this up in many past debates. It's probably something I should have brought up in our session here together. This is showing a relationship of the number of put contracts versus the number of call contracts that are out there. And when the number is under 1, that's telling you that there is more call contracts out there and the more contracts have been opened. We see that the put-call ratio here for CP is just a shade over 0.03. So it's reflecting some bearish tendency here in this regard. Or bullish tendency, I should say.
I was going to say at the end, we're going to give like a. And here, I like you so much, buddy. I'm going to give you one.
It's an April Fool's. You're trying to pull fast, right?
All right, thanks for that. If there's a stock you want to see our debaters go head-to-head on, send your suggestion to td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website. And if you scroll down, you're going to find a tab that says Join a Live Masterclass. This Wednesday, 2 p.m., the team is hosting an interactive session about TD Active Trader. It's going to explore how to customize the platform and familiarize traders with the tools needed to trade and manage options with ease. Registration is required, and it is open now. The TD Ultimate Investor Contest is officially live. Canadians can enter today for a chance to win a black iPhone 16 with 128 gigabytes of storage, a check for $500, a book kit featuring 5 educational books on investing, and a 1-hour private Q&A educational session with a TD Direct Investing Education Manager. To enter, visit the TD Direct Investing Facebook page, follow TD Direct Investing, and like the TD Direct Investing contest post dated March 24, 2025. You can also gain a second entry by following TD Direct Investing on Instagram and liking the TD Direct Investing contest post dated March 24, 2025 there as well. There's a limit of 1 entry per entrant per social platform. The contest runs until April 22nd, 2025. Scan the QR code for full contest rules and details. Another great show, but before we wrap up, there's nothing happening for the rest of the week, right? Nothing we need to pay attention to?
Nothing much.
Maybe
Greg,
a thing or two. I'll let you guys take it away.
Yeah. So, of course, macro data coming out this week, but obviously tomorrow's the big day. It's like D-Day or Liberation Day, as some like to call it. So we'll see what shakes out of that, and that's going to really present, what's already been a volatile week, just adding more to the mix. But apart from that, we also have the one data point that I'm going to be keeping an eye on, and so on Friday's non-farm payrolls report that's coming out. Consensus is 128,000. So really, any surprise to the downside may indicate, again, we're a weakening economy. We're going in that direction, of course, and that comes back to the Fed again. Is going to really change their tone on possible rate cuts there. But apart from that, Greg, the other stock that I'm looking at is Celsius Holdings, CELH. So you might have seen it in the grocery aisles every now and then, since it's a new energy, no, I shouldn't say new, but it's an energy beverage company now.
The energy drinks.
Yeah, but more on a health focus, spin to it. So they've really, they really tout themselves using clinical trials to say we're really health focused, so using things like, caffeine, ginger, green tea extract amongst some of them. And they've seen a little bit of a bid come up on their stock. I've got the charts pulled up here, but one of them, the big thing that came out just recently or a couple of weeks ago was they announced the acquisition of Alani Nu, which is in fact their next direct competitor. So out of the space, you got Red Bull, you got Monster Energy, you got Celsius and Alani Nu. Now Celsius and Alani Nu are combined. And the reason why they want to bring those synergies together is because Alani Nu really appeals to the female sort of, consumers. And so bringing them together is going to be something that's really going to be a bit of a tailwind for them. Just some of the stats, they in fact have, Red Bull has 3 times the size of Celsius. But they beat them on sales on the quarterly basis so far. $489 million in sales. And you're talking about market shares at 36% for Red Bull. Prior to this, Celsius was at 11% market share. Combined with Alani, that's at 15% market share. So there's a bit of sort of tailwinds on the push here. So where we could see it kind of push if it does move, if this momentum continues, it broke above the 200-day for the very first time after like a long sort of downturn over here. So 39 up to the 49 level is where it could push if this momentum continues to build up. So one to keep an eye out on in the coming weeks.
As you get older, you got that cranky old man in your voice in your head. I'm like, what happened to coffee black? It's my energy. I'm too old for that game.
Yeah.
What are you looking at, Jim?
All right, so what's more American than baseball, bourbon, and we're going with the B theme. We're sitting with blue jeans.
Blue jeans.
All right, I'm going to look
like
at Levi Strauss. They've got their earnings coming up next Monday. So you mentioned it already. Liberation Day, as it's been termed by some down south, is happening tomorrow. So there's still time for Levi's to get their story straight before they go public after the bell next Monday. All right, so many, like you might expect, many companies in the fashion and accessory space, they do produce many of their goods overseas, and Levi Strauss is no different. Even with something as iconic to the American culture as blue jeans, we've got 20% in each of these economies in terms of their production: China, Bangladesh, and Vietnam, and then 15% coming out of Mexico. So we're talking 75% of their products are coming from overseas. Now, yes, they do produce some of their premium labels in terms of the premium as well as their vintage labels in America, but it would be interesting to see what's said on the call. But taking a look at their chart, kind of what I wanted to point out here today is we can see that they'd had a kind of a significant gap down kind of late towards the summer, but then the stock has been trading kind of relatively sideways until very, very recently. What we've noticed is that kind of coming into earnings, though, there is a kind of a wedge form pattern that's formed, and the stock has broken out to the top side and has not continued down. Has been able to find support around the 15.15 level. So we'll see if that continues. And one of the nice things or positive things that I've noticed as well, we do have a MACD line has been crossed the signal line. It's then trending up towards the 0 area, so that could be another bullish signal as we head in towards the weekend. But as we know, there's still lots of time left in before earnings, and lots of time to see how the global economy can be shooken up, and we're all kind of waiting breathlessly, if you will.
Yeah.
So.
And for full disclosure to the audience, at current moment, I'm wearing Levi's jeans. Just thought they should know.
They should know that,
yes.
Another great show under our belt. Maybe I'll model them around later. In the final shot, we'll meet again next Tuesday, and the world will still be here, and we'll have plenty to talk about. That's the show for this week. As always, investors should perform their own due diligence before trading. Thanks for watching.